All right, welcome everyone. Go ahead and find a seat, settle in, and grab your notebooks. I am absolutely thrilled to have you all here in class today for our Advanced Financial Accounting Masterclass. Now, our goal for this session is an ambitious one, but it is incredibly rewarding. We are going to master the Vietnamese accounting standards, specifically looking at how they apply to inventory. You see, inventory is quite literally the lifeblood of any product-based business. If you want to succeed in your future careers as accountants or financial professionals, understanding exactly how to record, value, and track this stuff is absolutely essential. So get ready because we're about to cover some seriously foundational concepts. Let's get started. Okay, let's dive right into our syllabus for today so you know exactly what to expect. We'll start with Chapter 1, Legal Framework and Regulations. Then, Chapter 2, Inventory Valuation Principles. After that, Chapter 3, Documentation and Workflow Process. Moving on to Chapter 4, Raw Materials Accounting. And finally, Chapter 5, Merchandise and Real Estate. Starting off with Chapter 1, let's establish the legal framework and regulations, the true foundation of VASO 2. Now, before we even think about touching a ledger or calculating a single cost, we have to ground ourselves in the 2015 accounting law. Two principles here are your best friends, the accrual basis and the principle of prudence. The accrual basis simply tells us that we record transactions when they actually occur, not just when the cash changes hands. And prudence, that ensures we never, ever overstate our assets, which is a golden rule for inventory valuation. Depending on where you end up working after graduation, you're going to follow different circulars. For large and medium enterprises, you'll use Circular 99 of 2025. This gives you the full, robust suite of inventory accounts, all the way from account 151 to 158. But if you're at a small and medium enterprise, an SME, you'll look at Circular 133 of 2016. Because SMEs have simpler operations, the rules are a bit more streamlined. For instance, account 158, which is used for complex tax suspension warehouses, is entirely gone for SMEs. They just don't need it. Of course, we really can't talk about accounting without talking about taxes, right? So please make sure you take some notes on this part. When it comes to value-added tax, or VAT, you have to clearly separate deductible input VAT from non-deductible VAT. If it is deductible, keep it out of your inventory cost. But if it's non-deductible, then it gets baked right into your historical cost. Next up, corporate income tax. Under the 2025 rules, your cost of goods sold is a perfectly deductible expense, but, and this is a big but, only if you have the proper valid documentation to back it up. Lastly, keep Circular 48 of 2019 in mind. It lays down the strict rules for how we set up provisions for inventory devaluation. We're actually going to calculate one of those together a little later in the lecture. Let's move on to Chapter 2, Inventory Valuation Principles, where we figure out how to calculate the true cost. An accurate valuation is the absolute beating heart of financial reporting. Think about it. If your inventory value is off, your cost of goods sold is wrong, which means your gross profit is wrong, and suddenly your entire balance sheet is just misleading investors. In Vietnam, we have 5 approved methods to calculate this. First, specific identification. This is for your high-ticket, totally unique items like luxury cars or custom jewelry. Second is the weighted average method, super common in manufacturing to smooth out crazy price fluctuations. Third, we have FIFO, first in, first out. Just assume your oldest stock is sold first. Fourth is the retail method, which is the go-to for supermarkets that have thousands of low-value, varied items on the shelves. And fifth, standard cost, which you'll see in continuous, highly predictable manufacturing environments. Now, what's really interesting here is how we handle complex manufacturing. What happens when making your main product spits out a byproduct? Imagine a factory making beautiful wooden dining tables, and as a result, they generate tons of sawdust. You can actually sell that sawdust. The crucial accounting trick you need to remember is this. You must determine the net realizable value of that sawdust, the byproduct, and actually deduct that value from your main processing cost. This ensures your dining tables aren't unfairly burdened with costs that you're going to recover anyway. It's a very neat little adjustment. All right, Chapter 3, Documentation and Workflow Process. We are taking things from the physical warehouse straight into our ledgers. Let's step out of the theoretical clouds for a moment and walk onto the warehouse floor. To keep our ledgers legally accurate, we need a flawless paper trail. Let me list the absolute essential forms you'll deal with daily. Form 01-VT is your goods receipt. This is the bedrock document proving what actually came through the receiving doors. Form 02-VT is your goods issue, and that's the trigger for debiting your production costs. Now everybody, draw a giant star next to Form 06-VT in your notebooks. You use this when buying goods from someone who can't issue a standard invoice, like a local individual farmer. Here is the strict warning. Form 06-VT absolutely does not allow for any VAT input deduction. Do not make that mistake.
Now take a look at the structure of Form 07VT, the allocation table for materials and tools. I like to think of this form as a bridge. At month end, this piece of paper helps us officially credit our inventory accounts, like 152 for raw materials and 153 for tools. At the exact same time, it directs us to debit our production accounts, like 621 for direct materials or 627 for overhead. It perfectly and legally shifts the cost from the shelf into the production line.
Let's see how all this paperwork builds into a daily routine. There is a chronological 6-step physical warehouse workflow you need to know. Step 1, checking the validity of those documents we just talked about. Step 2, the actual physical import or export of the boxes. Step 3, the storekeeper updates the physical stock cards, but strictly focusing on quantity, not money. Step 4, determining the daily inventory balance on the floor. Step 5, taking all those physical documents and transferring them over to us in the accounting department. And Step 6, perhaps the most critical, the vital monthly reconciliation between what the warehouse physically counted and what our ledgers say we have. While the folks in the warehouse are managing forklifts and physical boxes, we in the accounting department have our own very strict responsibilities. Notice the big difference here. The warehouse only cares about quantity, but we have to track quantity and financial value. Our 3 core tasks are pretty straightforward. First, we verify the legal validity of every single document they hand us. Second, we record those transactions flawlessly into our ERP or accounting software. And third, we continuously monitor and synthesize all these values so we can ultimately prepare our financial statements.
Moving right along to Chapter 4, Raw Materials Accounting. It is time to truly master Account 152.
Okay, get your pens ready for some specific journal entry notes. Everything in Account 152 starts with historical cost. But listen closely. Historical cost is not just the price tag on the invoice. It's the exact invoice price, plus all the related purchasing expenses. Think freight, loading, insurance, plus any normal expected losses that happen during transit. However, there is a hard boundary here. If you are holding materials in your warehouse that belong to another company, say they sent you stuff for custom processing, those are strictly excluded from your Account 152. Why? Because your company doesn't actually own them.
Now, in the real world, you don't always have the final invoices in hand when you need to issue materials to the factory floor, so businesses use provisional or estimated pricing just to keep operations running. But at the end of the month, we have to fix those estimates. We do this using the price variance coefficient. Write this formula down. The numerator is the actual cost of your beginning inventory plus the actual cost of materials you imported this period. You divide that by the denominator, which is the provisional cost of beginning inventory plus the provisional cost of materials imported this period. Once you have that coefficient, you just multiply it by the provisional cost of your issued goods to magically reveal their true actual cost.
So let's talk about some real-world headaches. What exactly do you do when a shipment arrives, but goods are missing? Let's trace the T accounts. You discover a shortage, but you don't know whose fault it is yet. In this case, account 1381 is your best friend. That's the suspense account for shortages awaiting resolution. You debit 1381 for the missing amount. You only debit account 152 for the raw materials you physically held in your hands. Then, a week later, when the supplier admits it was their fault and refunds you, you simply credit account 1381 to zero it out and debit your cash or accounts payable. Simple as that.
What about the exact opposite scenario? You ordered 500 kilograms of cotton fabric, but the truck unloads 520 kilograms. You've got extra. Now what? Well, accounting principles say we have to reflect physical reality. You have 520 kilos sitting in your warehouse, so you must import all 520 into the system and debit account 152 for that full amount. Those excess 20 kilograms? You record them as goods held in custody, awaiting a formal resolution. Maybe the supplier will send you a bill for the extra, or maybe they'll send a truck to pick it up. Either way, it's on your books until it's resolved.
So the crucial point we need to discuss is what happens when our inventory actually loses value. Maybe market prices tanked, or maybe a roof leaked and water damaged the goods. Circular 48 of 2019 steps in here. We are legally required to calculate an inventory markdown provision to ensure our assets aren't overstated. The mandatory formula is pretty logical. Take the exact quantity of the inventory that dropped in value and multiply it by the difference between its original historical cost and its new lower net realizable value. We then record this provision as an expense straight to account 632.
Here's another fun scenario: outsourced processing. Let me map this out for you. You take raw materials from your warehouse and send them out to a third-party factory to be painted or assembled. To record this, you credit account 152 to show the materials leaving, and you debit account 154, work in progress. When that third-party factory sends you the bill for their labor, you debit account 154 with those processing costs. Finally, the finished goods arrive back at your warehouse. You credit account 154 to clear it out, and debit account 152 or 155. Now, that inventory carries the combined value of the original material plus the outsourced labor costs.
And that brings us to our final section today, Chapter 5, Merchandise and Real Estate. Let's look at some complex trading scenarios.
We're shifting gears now. We're moving away from raw materials that you use to make things and looking at finished merchandise you buy specifically to resell, which lives under account 156. And this next example brilliantly illustrates the complexity of buying merchandise. Let's look at a deferred purchase agreement. Your company buys a batch of refrigerators. If you paid cash today, the spot price is 500 million VND, but you negotiate to pay it off over 6 months, so the total contract signed is actually 530 million. As an accountant, what do? You only debit account 156 for that spot price of 500 million. That extra 30 million VND difference, that is recognized as a deferred financial expense spread over those 6 months. It is not part of the inventory's historical cost.
Just like we saw with raw materials, merchandise also has purchasing costs attached to it, like transportation, that we have to allocate to the goods we eventually sell. Let's walk through the math. We take the total purchasing costs, meaning our beginning balance plus any new costs incurred this period, and divide that by our total inventory value. We then multiply that ratio by the value of the goods we actually sold. So if we run the math and our allocated costs comes out to 57.6 million VND, we route that expense directly by debiting account 632, cost of goods sold, and crediting account 156. It perfectly matches our expenses against our sales. Before we wrap up, I want to briefly touch on a very specific, unique regulation. Real estate can actually be classified as inventory. If your company purchases a building specifically with the intent to resell it in the normal course of your business, it goes right into account 156 as merchandise real estate. Taking it a step further, if you have an investment property, maybe an office space you've been renting out, and management decides to stop renting it and aggressively market it for immediate sale, you actually have to execute specific journal entries to convert that asset out of investment property and straight into inventory. To conclude our masterclass today, I want to leave you with one final, very important thought to ponder. If your physical warehouse counts and your accounting ledgers are perpetually mismatching, are your financial statements actually reflecting reality, or are they just a costly illusion? I urge you, remember the critical importance of Step 6, the monthly reconciliation. Because without it, all these formulas, all these journal entries we just learned, they mean absolutely nothing. Thank you all so much for your focus and participation today. Make sure you study your notes, and I will see you in our next session.